Thanks everybody for joining us this evening. We're pretty excited. This is our second webinar in the financial series. We held, actually it's our third. This one is sponsored by MD Management, who are partners of the Canadian Association of Radiology. And they're here tonight to give us a perspective on the markets on behalf of our members. We live in turbulent times. Everybody's trying to protect their nest egg, trying to decide what the impact is of this financial calamity. So I'm going to introduce our two guest speakers tonight. The first one is Mr. Craig Murdoch. Craig is Vice President, Senior Portfolio Manager of MD Multi-Asset Management with MD Management. Craig is responsible for the management of over 40 billion in assets held in client portfolios, as well as MD's proprietary mutual funds and pools. With a career spanning more than 30 years in the financial services industry, Craig has developed his expertise in the management, delivery of high-quality investment solutions through various roles in investment management, sales management, and estate planning and financial planning. Our second speaker, joining Craig, is Kelly Costigan. Kelly's a portfolio manager for MD's Private Investment Council, who's been serving Canada's physician community for more than 20 years. As a portfolio manager, she works to develop customized wealth plans to set clients up for long-term success, meeting every financial need and goal along the way. On behalf of the CIR and MD, Craig and Kelly, I welcome you. Take it away from here.
Great, thank you very much. And thanks everyone for joining us tonight. Hopefully you find this interesting. We certainly believe that we are living in interesting times. I'm going to take off the beginning of the presentation, really talk about the markets, what's been going on, how it's been affecting investments, and then Kelly will bring you some practical information as to how you might want to deal with that from a personal investment perspective. Maybe just to add to my bio, I thought this might give you an idea of who I really am. So back in August, I had a small incident, broke my left clavicle and had it repaired. So maybe at the end you can all tell me whether or not you think they did a good job on the repair. But as we really get kicked off with the discussion, I just want to maybe remind people of who MD is. So probably familiar with MD Management. We were previously owned by the Canadian Medical Association. Been in operation since 1969, and over the last couple of years has been working on the integration as we were acquired by the Bank of Nova Scotia. That's been an important milestone for us, because as much as we are the #1 financial services firm dealing with physicians in Canada, we deal with more Canadian physicians than any other firm, and as I mentioned, we've been doing it for over 50 years and with offices across the country. It's been a very good and successful structure to allow us to deal with Canadian physicians. But as we've now started to work with Scotia, we've now taken our $50 billion that we manage on behalf of Canadian physicians, and we're thinking about how we work with our colleagues over at Scotia, who manage closer to $500 billion in assets. And the collective strength of MD and Scotia together means we're able to bring better products, better services, more advice, and really an enhanced suite of solutions for physicians going forward, which is really exciting. And then with that, as I mentioned, the Canadian Medical Association, well, we've removed that one relationship. We've added a number of new ones, and associations like yours. We're now up to about over 20 associations where we're dealing with physician groups. And it's very meaningful for us to be able to make sure that we can continue to get the insights from physicians on a regular basis. It was great in the past with our long-term relationship with the CMA to have a perspective on physicians, what their needs were, how their occupation was evolving, and ultimately how we delivered the best financial services for them. As we deal with specialty organizations, we're finding that we're able to get better information, more robust information that should allow us to continue to tailor our products and services and ultimately give better service to physicians going forward. So it's a very exciting time for us at MD. It's a new chapter in our evolution, and we're excited to be able to speak with you today. Now, for the crux of the discussion, it's our outlook and our positioning. So I'll go over what's been going on in the investment markets over the last quarter predominantly. It's been evolving very quickly, and we've had to adapt and respond to that change very fast. And at the end, I'll talk a little bit about our positioning, our current positioning, how we're set up for things today, but importantly, how we see things evolving going forward and how our positioning will likely change in the coming months through the next year. So maybe as a backdrop and the positive backdrop, so this is a picture as of December 31st for the last year in equity markets and fixed income markets. So for those who don't recall, it seems like a long way away. 2019 was a fantastic year for investments. You can see that Toronto stock market up almost 23% last year, US equity market being the S&P 500 up almost 25. Even emerging markets, which trailed from an equity standpoint at over 12%, was still a pretty phenomenal year. And for those of you who would have listened to my discussions at the beginning of 2019 when bond yields were exceptionally low, I would have told you that interest rates were low and that likely to get a good return on of bonds, somewhere around 2% over the course of 2019 would have been a really good outcome, and it would have been a lucky year for bond investing. Of course, 2019 was a very different year. We ended up with very strong equity returns, and through the year, we actually saw interest rates start to decline, which is why the Canadian bond universe was up almost 7% last year, which meant overall for investors, a fantastic year in 2019. Now, we were warning our clients that even though we saw a great 2019, we didn't expect anything near the kind of strength we saw in 2019 to show up in 2020. We were positioned to, mildly, with a mild cyclical overweight, which meant we were bullish on equities at the beginning of the year, although we were cautious given where valuations were. So if you look through our portfolios, you would have seen it with, let's say, a mild overweight to equities, believing that equities would outperform fixed income throughout 2019. That was playing out very nicely through January. And of course, as we started to see the evidence of COVID-19 showing up in China and ultimately move out around the world, that's had a profound impact on not only equity markets, but fixed income markets as well. So dialing forward to now, what have we seen so far this year? Well, this is to the end of March. Oddly, I probably could update this chart every day and these bars would move around a lot. You've definitely seen markets being extremely volatile, but just for the context of what we're really dealing with, as of the end of March, we saw a major collapse in equity markets. They were down roughly 30% at their lows. So even through March, we saw a slight pullback, at least some small rebound in equity markets. And fixed income markets, albeit not really strong returns for a quarter, 1.6% return is not bad, again, given the fact that interest rates have now come down quite significantly. This is obviously a stark contrast to the chart I showed you for 1 year. You basically erased all those gains in one short quarter. And not so much just one short quarter, but really in a period of just a few weeks. So if you actually looked at the plot of this over the course of the last year, as I mentioned, equity markets were pretty good through 2019. You can see all of these lines being the major equity markets around the world. And in fact, as I mentioned, into January, and quite frankly, right into about mid-February, you saw equity markets continue to move up. In fact, the S&P 500 around the second week of February was at its all-time high. So it never reached a point in time where its value was higher. Dial that forward a few weeks, we've seen one of the most significant collapses of equity markets ever. So, you go back to the Great Recession, you go back to the crash of '87, you go back to the IT bubble, you go back to the financial crisis. Hard to see a chart that looks anything like this with the speed that this is unwound and the amount of declines we saw. So unfortunately for many investors, there was not a lot of protection available in the midst of this crisis. If your portfolio was positioned defensively going into this, there's a good chance you didn't bear all of the brunt of this. But the speed that this was unwinding was almost impossible for investors to try to react to in the moment. And as we've seen volatility spike up significantly throughout this event, every day is a new day. It could be up, it could be down, and the ups and downs have been very significant. We've seen some of the highest one-day moves in markets, be them up or down, happen in the course of the last few weeks. So very significant event and very impactful with respect to what's going on in equity markets. Just for contrast, we went back and looked at what happened in the IT bubble. So back in the 99 to 2002 IT bubble, and as well I've got another chart on the financial crisis, just to put into perspective just how quickly things unraveled in this current event. So in the IT bubble, we definitely saw a blip down at the beginning, and I think this is also an interesting point. There was a recovery fairly early on after the first real drawdown in the IT bubble. Markets moved back up, but then they did fall off quite significantly again at the end. So this is fairly typical of what we tend to see for markets as they wrestle with moving from what's perhaps a correction into what might become a more sustained recession and ultimately a prolonged bear market. So this is just an example, but when you look at the chart here and you compared that to the previous chart, it's just vastly different. The speed at which the IT bubble unwound was a very slow progress before we finally ground down over a year versus what we've just seen over the course of just a few weeks. Financial crisis was a little bit different, similar pattern at the beginning where you saw an initial drawdown of markets. There was then an expectation that you'd see recoveries. There was an expectation that perhaps the mortgage market in the US is going back to the 2000s, the 9 financial crisis, but there was perhaps some issues that maybe the mortgage system could be saved. That maybe some of the bigger players would be able to take out to some of the smaller players, but there wouldn't be any major collapse. Of course, that's not what happened. We saw a huge collapse of the financial system, freezing of the financial system, and then we saw a much more major collapse several months later. So just really to kind of give some perspective around where we are in the markets and why it's difficult to figure out what's going on now. It's pretty easy to try to figure out what's going on now. It's hard to figure out where it ultimately will go, given the speed that we've seen this unravel. But the good news is that has already been a lot of support for the economy and ultimately which should help markets, stock markets, bond markets in the future. But we don't expect that we're at the end of this. In fact, we're probably at closer to the very beginning when you compare where we are today on this chart to where perhaps we saw in the financial crisis fairly early on. So to add some additional context to what we've seen and what's fueling some of the big sell-off in equity markets, it's also bond markets. Bond markets and bond investors, and in fact bond institutional investors, tend to be more, I'm going to call it clairvoyant, or at least leading from a perspective standpoint. Oftentimes the equity markets pick up cues from what's going on in bond markets. We did start to see a fairly significant move downward in interest rates. So this would be the bond market response to interest rates, not necessarily what you hear from central banks. You often hear of the Fed dropping interest rates or Bank of Canada dropping interest rates. They're usually last to the party. In fact, the bond market itself, which prices bonds on a daily basis, responds far quicker and had already dropped interest rates to all-time lows before the Fed stepped in with some very emergency accommodative policy. But what you're noticing on this chart on the far right is two things. One is just how fast interest rates fell and how low they are. And another important characteristic is what we call how flat the yield curve is, or if in fact the yield curve is inverted. So each of these lines is a term. So you'd see the one at the top, the orange line is 20-year bonds, second one 10-year bonds, 5-year bonds, and 2-year bonds. And if you went back out to say 2016, that's what would be representative of a more normal slope in a yield curve, which basically means if you're going to lock your money into a bond for 20 years, you should expect you're going to get a higher return than if you put it in for only 2 years. What you're finding now with the bond market is the bond yield curve is flat or inverted in some parts of the curve, which basically means you're going to get paid the exact same amount for a bond, whether you lock it in for 20 years or 2 years. And sadly, the amount you're going to get for that is close to zero right now. So interest rates are exceptionally low. The reason they're exceptionally low is because of the impact of COVID. So certainly of COVID-19, there's the medical issue, which you're all dealing with, likely on a daily basis. The economic impact of that, and that economic impact is really due to shutting down just about everything in the world. So almost all economic activity around the world has been taken offline, which has a significant impact on the economy, on the ability for companies to earn money, and the natural policy response, and ultimately the natural response from bondholders is to push interest rates down to a very low level, which is what we call providing accommodation or support for companies to ultimately borrow at very low rates to kickstart the economy once again. So this has been as well a fairly significant drawdown in interest rates in a very short period of time. in response to the biggest global shutdown of an economy, of the global economy ever. Of course, on top of that, or in the midst of it, so partway through the first major sell-off in equity markets and the repricing of risk assets, Russia and Saudi Arabia decided that it would be a great time to have a spat around oil prices. What was OPEC plus has basically collapsed. They've now decided to go their own separate ways. Saudi Arabia decided most likely to flood the market with cheap oil. There's speculation as to what the real rationale on that is. Some of it's to say they're going to fight the U.S. shale oil industry that's coming online. They've also just launched their own, or went to public with part of their own company, Saudi Aramco, the state-owned oil company. So there's definitely some politics going on in oil right now, at the same time when there's a significant disruption in demand. So the fact that most people right now are working from home and or are not working, and definitely very few people are traveling, whether it's for leisure or business, that means the oil demand has really dropped significantly. You add on top of that increased supply, no surprise you're going to see a very strong collapse in oil prices, and one of the strongest collapses we've seen previously. I'd love to say we have great insights as to where we think oil would be. We're quite frankly waiting until we see the sort of natural supply demand dynamics come back, where we can get some insight as to what's going on. I would not want to be a betting man as to what Saudi Arabia or Russia might actually do. We believe oil is likely to stay at a depressed level due to the decline in economic activity, but trying to bet on the movement of oil on a day-to-day basis right now would be a very big challenge. It normally is a big challenge. It's a much bigger challenge due to the additional politics going on right now. But it is important to what's going on in the global economy. And well, in Canada, we talk a lot about oil prices because we are an oil exporter, and it's certainly material to our industry and ultimately to our stock market, as we do have more oil exposure than most other countries. For the most part, most countries and most companies are users of oil, and as a result, the lower price is actually a good thing from a cost standpoint. If you think of input costs into, say, a gold mine being diesel fuel, gold mines are obviously more productive today than they were before because they can buy their fuel at much lower costs. So the long-term impact of this from a recovery standpoint for the economy, it's actually a nice plus. The fact that as things do come back online, one of the major input cost of industry is actually at trading at a very low level right now. Now, the other side of the bond market, I mentioned bond interest rates came down very significantly. The other side of that is what we call credit spreads. So it's the pricing of the risk of the potential that a bond does not get repaid. So typically when we think of bond markets, we're thinking of government bond markets, so whether that's the US Treasury or Canadian government bonds, they are theoretically backed by the governments. Now you might wonder if the governments continue to borrow more money and give it back to us. How safe those countries are, we'll get to that probably sometime way into the future. But for now, there's definitely a view that, for instance, the US Treasury will be able to repay any bonds that they've issued. But in the corporate world, where a company has borrowed that money, not only do you have to worry about the interest rate on the bond, you also have to worry about whether or not they're capable of repaying that bond. So one of the other measures we monitor from a market standpoint and ultimately look at how it impacts our investments is credit spreads. You'll notice on this chart as well, very similar to what we saw in the equity markets, credit spreads had widened out quite significantly, which basically means you're going to reprice the risk and you're going to get paid more in the future for taking on that credit or owning that bond. Unfortunately, if you owned that bond prior to when this went out, that means those bonds would have lost money in this environment. But really what the market's telling us right now, you see it's gone up, it's also started to come back down a little bit, but it's significantly elevated compared to where it was before. And that's the financial market's way of telling us that the probability of not getting paid has gone up for a number of different issues. So I mentioned the oil prices going down, no surprise. The likelihood of an oil company being able to pay back their debt in the future has definitely gone down because the price of one of their commodity has in fact also gone down. So therefore with that, their profitability. So this is an important metric to determine whether or not the markets are getting back to, call it, normal. and pricing the probability of default lower. Right now, it still remains elevated, and we expect it will continue to stay elevated for the foreseeable future, as the industry is pretty much locked down at this point in time. Now, within all of that, and I mentioned before that the day-to-day movements of the stock market, we've seen some records, not only records in, last week's return was one of the record weeks in the market going up in the last, well, I think since the 30s, quite frankly. And within that, we've seen extreme days, the best return in a day in many, many years, and the worst return in a day in many, many years. And the way that gets shown up in the market is called the VIX, or Volatility Index. And you can see on the far right that the VIX spiked, as we would say. It went up to a higher level than was even seen in the 2008-2009 financial crisis. And what the VIX is measuring is the uncertainty of the market. And if you think of uncertainty, it is the difference of opinion that market participants have on the information that they're staring at any given day. So for the last number of years, the VIX has been running at extremely low levels. And what that would mean is that the market participants pretty much agreed that the price they saw today was the right price. So if Kelly and I wanted to trade a stock today, I said it was worth this. Kelly said, yeah, I think it's worth that. We wouldn't really bicker about the price. We agreed on it, moved on our merry way. Today, however, because the VIX is so high, it's telling us that the market participants do not agree. And the reason they don't agree is because we are dealing with such an uncertain level of economic activity. Everybody is trying to predict when things will settle down, how long we might be in lockdown, what the impact of the lockdown might be, what the knock-on effect of employment might be, temporary or longer term. Ultimately, will it show up in the profitability of companies and their earnings, and how will their earnings come down? And we follow a variety of different researchers. We have a lot of different inputs that we have into our process. And we've got extremes from predictions that we will see a recession similar to the Great Depression. So that sort of magnitude around this turning into not just months of significant decline in economic activity, but could potentially turn into years of setback. You have others who suggest that this is going to be a blip. And that they're in weeks, not the Donald Trump weeks, but in true weeks, we will actually see economic activity come back online, and everybody go back to work, and the economy's just back to normal. And in fact, all the predictions that people had at the beginning of the year will likely be realized by the end of the year. We just had a little hiccup along the way. So when you have that kind of extreme difference of views, no surprise, you get everything in the middle, and that causes this extreme amount of volatility and uncertainty. So I'm sure there'll be questions around what do we think is going to happen. I'll have to say right now, very few predictions right now will be true. There'll be lots of ranges around them, and anybody who's giving you a prediction where they think they know what's going to happen, I would challenge them hard, because they definitely do not know what's going to be happening. And that's why we have to try to balance and deal with that information and manage portfolios the best we can in that high level of uncertainty. And the reason we say that, I used the charts at the beginning to kind of talk about what was going on in the markets today and contrasting that with a couple of more recent downturns we've seen in markets, probably two of them that a number of people on the call have probably lived through. You may have also lived through those with MD. I joined MD in 1999, so I worked with clients directly back in the IT bubble collapse, and I was working on the investment side at MD in the 2008-2009 financial crisis. So I've lived through two, and I'm now in the midst of the third, working at MD with our clients. We often have to try to figure out whether what we're faced with is a correction. So if you think back through the fourth quarter of 2018, we viewed that at the time as a correction. So we looked at the economic information that we were dealing with at the time. We noticed, no surprise, the Fed was starting to increase interest rates to try to slow things down to get ahead of possible inflation. Markets responded fairly negatively to that. And the reason it was is because even though the economy and markets were on a stable footing, they weren't really strong enough to support the unwind of some of the accommodation that had been provided previously. But the underlying fundamentals still looked sound, and there was no reason to believe that that correction would likely turn into a prolonged bear market. This time is definitely different, in a sense that we have seen definitely a pullback significantly over the last few months. It was a pullback due to the first off uncertainty around COVID, COVID-19. And then on top of that is the fact that it is likely to turn into a prolonged recession. All indications right now would suggest we are heading, if not already in, a global recession, which means a slowdown in economic activity, so less production in a quarter than previously. What we have found from looking at history is that certainly from a peak to trough in a bear market, on the median bear market is pushing around 30%. We did see peak to trough so far around 30% in this pullback. We also note that unlike corrections, where their drawdown and recovery lengths are fairly quick, in a bear market, the drawdown time tends to be much longer. So think of 14 months, and I mentioned we're really a couple of months into it. Now with the severity of the drawdown and how fast we got into the bear market, it may mean that this one perhaps could be a bit shorter in its total drawdown. It doesn't mean it will be. But then look at the recovery side is typically 14 months. So two things that we believe is likely to be the case. We think this will be a shorter-lived drawdown and very much likely a shorter-lived recovery because there's been so much accommodation put in place already. So a lot of the tools that were developed back in the financial crisis, so terms like quantitative easing and TARP programs, these were all programs that the federal government in the US put together, and they certainly spread and were used around the world. But there were ways for governments and central banks to step into markets to make sure that the liquidity of the market was functioning and that the financial system was able to function, and as well provide lots of ease for investors and ultimately for companies who are operating to go about their business without the major costs. So lowering interest rates, as I mentioned earlier, is one of the most powerful ways to do that. If you're a company and you're looking to put a project in place and you can borrow that money for almost free, it pretty much makes every project you look at a pretty good project. As long as the project has a way to make money, you don't have to worry about the cost of your debt. You don't have to worry about paying back that debt necessarily right away, in which case it should mean that every project that looks attractive from a corporate finance standpoint really gets put into place. On top of that, there has already been a significant amount of accommodation around fiscal spending, $2 trillion out of the US already, and another $2 trillion today to support bond markets. It's just massive amounts of spending by the US, and again, other economies around the world are following suit. No one to the same degree that the US has for sure, but definitely supporting the markets and making sure that they are able to function, and making sure that credit markets, as I mentioned earlier around corporate bonds, are supported and are unlikely to default in a significant way. There will definitely be defaults. There will definitely be bankruptcies. There will definitely be people who are laid off or unemployed today who will remain laid off and unemployed even after the dust settles around COVID-19 and with this accommodation in place. But with the amount of stimulus that's been put into the system today, when things get back to normal or start getting back to normal, there's a very strong reason to believe that that will be positive for the economy and positive for companies that are operating in that economy. Unfortunately, the visibility on that timing is very difficult. So we typically, when we're assessing portfolios and trying to make decisions, we try to time all of our decisions out 12 to 18 months. It gives us what we believe to be a reasonable time frame to consume information, to look at trends, to follow the patterns of the business cycle, and to make adjustments to portfolios. Those adjustments can show up in a number of ways. We often describe them as equities versus fixed income, but we also look at relative positions across within fixed income, across currencies, within sectors. It's a wide variety of decisions we're able to make to augment a portfolio to try to help it to navigate what's going on in the economy in real time. This display right now shows you that we are sitting currently with an elevated cash position in portfolios. And I think it's important to note that as much as our normal tools are calibrated to look out 12 to 18 months, we're kind of looking down a little bit right now. So heads down, looking out more 3 to 6 months. And we believe that in that 3 to 6 month environment, there still is significant more risk to show up in the economy and ultimately in the companies that we would own on behalf of our clients. If you think of earnings as an example, so with companies pretty much offline, be it a restaurant, a hotel, an airline, an automotive company, pretty much anything that's non-essential today, their profits are either significantly reduced or non-existent in the current environment. Financial services, unfortunately, as much as they're strong, and Canadian banks are extremely strong, very well capitalized, will make it through this no problem. They're definitely as well going to take a slight reduction in return as people are extending mortgages out for some period of time. So I think I read something the other day, 500,000 people have already asked for mortgage forgiveness for a 6-month period in Canada, which is revenue the banks won't collect for that period of time. So these impacts are going to be profound on the economy, and they're going to start to show up in what we call the hard data over the next number of months. So we're going to see that in the unemployment numbers. We saw another weekly print out of the US today, and it's the most significant rise in unemployment. 10% of the US population is now unemployed. Now, some of them laid off, some of them will come back, but it's just a significant number of people that are offline. And there's probably a lot more than that that haven't necessarily gone through the system and haven't showed up in the numbers yet. We're seeing a similar event happen, obviously, in Canada and around the world as countries have shut down businesses, told people to go home, stay home to prevent the spread of COVID-19. So we believe at this time it makes sense to be prudent in managing portfolios, to be more defensive in the face of possible additional risks that will show up in not only the economy, but also the equity markets over the course of the next several months. We'll be looking for a reduction in the case count, a very strong flattening of the curve, and some signs that the economy is in fact able to get back to normal. So that will be people coming back to work and actually getting paid by the businesses and not by the governments. It's a flow through, economic activity picking up, and some signs that as a society we're able to deal with things like social distancing while working versus sending people home and having them stay home and be less productive than they might otherwise be. So for us, we feel very comfortable that it's prudent to be defensive over the foreseeable future. At the same time, of course, we've seen markets rally fairly significantly over the last few weeks, so move back up in response to what I mentioned earlier is very significant accommodation, both monetary and fiscal. So whether that's interest rates being low or governments, quite frankly, throwing money at the problem right now. Money will not solve the issues that we're facing with today. They definitely will help to repair things in the future. So we are optimistic long term. We're certainly slightly more risk averse in the short term. So with that, I'll introduce Kelly and have her walk you through some advice on what you should do based on how we're currently thinking about investments.
Hi, everybody. So the big thing that I do as a portfolio manager, and Craig, you can go to the first slide if you could. The first thing that I do is I take all of the information that Craig positions for portfolio managers such as myself across the country, and I actually deal day-to-day basis with clients like you. And what happens is all of the information that Craig provided, one back, Craig, if you wouldn't mind, just that very first page. There's really 7 things that come to mind and that I think are very important. You often hear, whether you believe it or not, to stay invested. And one of the reasons that I smile when I think about stay invested is, I'm not sure if you realize, but investors lose more of their potential returns after, not during a market decline. And one of the reasons that happens is you tend to sell after taking serious losses and you don't return until the market improves. That's what you think you should be doing. But the likelihood of you actually getting a better return by trying to time the market has been proven incorrect over many, many years. And in fact, if you try to time the market and you end up missing the top 10 weeks during a 20-year period, you tend to not even do the same kind of long-term return that a buy and hold strategy would do. So from a staying invested perspective, it's the conversations with clients are really around making sure that you have the right strategy for you and not trying to time the market, but just what your planning is. Number 2 is one of my favorite areas because it's all around the rational side of a person when markets are falling. When markets are going up, I tend to not have conversations about risk because everybody's happy. You have a portfolio and it's going up and you don't think that there's any risk there, and it just makes you happy. Everybody's like that. So from a rational perspective, think about markets falling and how strong your emotions are, and maybe the impulsive decisions that you're making, and maybe sometimes even paralyzing behavior. Because if I know that you have the right strategy, because we've spent time together and many years in building that long-term strategic mix, the short-term calls that Craig and his team make, the tactical calls, add to performance, and in this particular case, protect you, allow us to give up a little bit of return in an up market for the sake of protecting you, and that's really how we do things. So some of the things, just from an interest perspective, hopefully for you, some of the things that I deal with from a behavior perspective when I'm having conversations, and you might see yourselves in some of these things. One of the things is called anchoring. And I talk about anchoring a lot because if a price of a stock was a certain number, you think it's going to go back there, and that's what's in your head. So sometimes you won't take advantage of that current position. Even if you're taking a loss, you just won't do it because you think it's going to go back. Recency is a really good one because calls that I make now and conversations that I have, investors don't look at what they put in to their investment portfolio. They look at the very top of the market, which might be February 14th in this particular case for 2020. And if you put $1 million into the portfolio January 1st of 2019, and on January 31st, 2020, that $1 million had doubled, but then that 2 million fell to 1.7 in this recent correction, you're thinking that you lost 300,000. So when you think about the recency, your memory is there for highs, and that's what you think you lost. So I deal with a lot of those kinds of conversations. There's also, and Craig, you mentioned this a little bit earlier, you might think that overconfidence is a big one. You might think that you're the person that knows when to get in and when to get out. But history will prove that it might be a little bit easier to get out, and you're having a hard time to get in. Because by the time you get back in, you have missed those top 10 weeks, and nobody has a crystal ball. So keeping with your strategy and staying invested and understanding that sometimes you're not rational in these kinds of markets is important. I'll just quickly talk about fee transparency because it's important to you. When you think about fees, it's important to understand that the companies that you deal with should be very transparent, because fees, depending on what kind of investment program you're in, a lot of them for the discretionary management are tax deductible. The other thing is, as market values decline and your a number of assets in both sides, whether they fall or whether they go up, in the case of falling, your percentages, of course, are less. You're not very happy because your values are going down. But one of the most important things to think about is, as your assets go up, the actual tier on the fees will get less. And I'm not going to get too much into that, but if somebody has questions on that later, I can go into it. We talk a little bit about debt, and one of the things to think about for debt management is don't give up opportunities so quickly. Particularly about rates being so low, and Craig again touched on the borrowing ability when you're trying to make sure your company's doing well. The same thing around if you have debt for a mortgage at 2% or a line of credit at 2%. And even your portfolio value, which might be falling, the dividends are a lot of times in excess of what your debt cost is. So it's a good conversation around discussing whether it's appropriate to pay down debt at this time or to continue to use it and let your investments roll. Now, one of the biggest parts about successful investing is number 6, and that's the asset allocation decision. So that's really the crux of what I do. And the most important thing I want you to take away from this is that your asset mix, your strategic asset mix, is responsible for over 90% of your success in retirement. And why that is the tactical or the short-term calls can help, but really that strategic asset mix has to fit your risk profile. It's about you. It's not about us. We have to really look at your personal investment goals. You've got to add and allow us to add complementary asset classes. You might not even look at what a complementary asset class is, but the reality is that we add them. We invest the portfolio so that all asset classes don't produce the same kinds of returns at the same time. And what that does is it reduces your risk. So think about your asset mix, your strategy, and if nothing's changed from January 1st, 2020 until now, relative to who you are and what your overall long-term plan is, then the reality is that this market shouldn't cause you to say, I should get out. And when am I going to get back in? Unless you've had specifics around your particular strategy, that's when we would make changes. So really from the planning perspective, the last one, have an investment plan. All of the others are not as important as having a plan for yourself with a planner. Whoever you deal with, you need to have your goals set out. You have to have your risk profile understood and see how you can sleep at night. Can you take 10% drops? What's the likelihood of a growth portfolio falling by 20% in the next 10 years? Or can you sleep at night with 10% or lower? So that's the realistic side of things. I've got to work with investors like you on a daily basis to bring you back. Really, there's no better word than just reality. To say, look, your strategic plan is still right. Leave it and let us do the short-term calls in between. So that's really the gist of successful investing. And Craig, you can just go forward to the next one if you wouldn't mind. I won't spend too much on the 6 elements of your financial plan. You can certainly deal with the person that you work with going here. But I just wanted to kind of point out what this sheet is for you, and if Dr. Barry wants to put this on your shared site, that's great. But it really just breaks down all of the things that you should be looking at when you look at your financial plan with your advisor. And then the next one, great. The importance of staying invested. I thought that you might like to see an actual numbered chart over the last 30 years. That shows what I talked about a little earlier about the cost of missing the best days. And in the most diversified market, US market, just to show you what that would be like, broken down by if you missed, what your returns would be if you stayed true to your mix, if you missed the 10 best days, if you missed the 20 best days, etc. So there is a lot of information around around telling you that it's important to stay invested. And then the last chart, I believe, under my little area there. It has been shown over many years that investors with advisors accumulate more assets. One of the things that we do over a longer period, and that's how it works there for the x-axis, from the shorter period of time to a longer period of time, it is proven through history that working with somebody who understands your goals and can talk you through the down markets, because like I said earlier, it's easy when the markets are up, to really concentrate on who you are and make sure that you get to the time frame when you walk into our office and say, I've been saving forever. Now it's time to be able to live off of the avails of my hard work, meaning you, because you're the one that saved, you're the one that's listened, you allowed us to manage for you. So that's my last sheet. It's more on the emotional side than anything else of what I deal with on a daily basis. And I guess we can move to the questions and answers if there are any. Thank you very much.
So I think to ask a question, there is a chat function on the webinar. It's probably the easiest way. If you want to type in questions, we'll be able to try to answer the different questions that come in. So far, I've seen questions around audio. Those questions came in around the latest market uptick. Is it a dead cat bounce? Yeah, which is a fun term that the market uses to try to determine whether or not what we've just seen is it a precursor to what will eventually be another down? Could also be considered a bear market rally. It's hard to know at this stage. Our belief would be that the risk is that we are likely to see more down. Now, whether we will touch the lows that we've already seen or whether we will see some slide backwards at some point in time as more bad economic news is consumed by the market, that's certainly what our thinking is. At the same time, it's hard to understand whether or not all of the stimulus that has been put in place right now, both monetary and fiscal, will allow the market to feel like things are normal again and look through the risk that we're going to see show up in the economy over the next little while. We've done a lot of work on trying to understand how the market has evolved since 2008, 2009 to today. It's definitely a different market. We're seeing different sectors obviously lead, so technology and what's in technology and even the consumer areas today is different than what we even would have seen in 2008 and 2009. The amount of energy in the market is much lower today than it was then, financial services as well, so the composition of the market's changed. Then we tried to figure out what is what we would call a trough multiple. How low should the market price things from a PE multiple in the face of a recession? Typically that's been single digits. We would think it's more likely, given where interest rates are and where the market is, that multiple should in fact be a little bit higher even in a trough. So thinking that 12 to 14 times multiples is probably fair. As of end of today, S&P 500 was trading back up at 18 times. 18 times is a healthy multiple for a well-functioning, mature market, not one that is in the beginning of a massive recession, the likes of one we haven't seen in a long, long time. So our view is we're likely to see more pain before we see the glory come back out of this market. So dead cat bounce, probably a good call for it. We could see a good run here for the next little while, regardless of whether or not we see more negative news showing up later. Next question was around sectors in the market. Which sectors would we advise investing in? All of them. Of course, the weights that you would use would depend on your time horizon. So as Kelly mentioned, longer term investors, if you truly are anchored to your long-term strategic asset allocation, you are truly going to invest in all of the sectors. You want a diversified portfolio. How you diversify that and which sectors you emphasize in your portfolio could depend on your current view. So a shorter term view, if you are defensive, and you do believe that the downturn is likely coming, but even though it's coming, you don't want to get your money out of the market. And even when we take money away from the market, we talked about our tactical positioning. It's not like we're taking all of the equities out of a portfolio and going to zero. We start with a portfolio of 60% equities. We might have lightened it up to in the 54% range. There's still a tremendous amount of equity market exposure in a portfolio that's going to work if markets are rounding like they are today. But defensive sectors, typically you would think consumer staples, no surprise, Loblaws is going to do quite well through this and tends to be a fairly defensive sector. Healthcare would be another defensive sector, obviously, in the current environment, just given the amount of attention the healthcare sector is getting right now. And then utilities would be another normal, traditional defensive sector if you were concerned about the downturn and trying to protect yourself. If, however, you were looking to the future and believing in the recovery case, you would overweight sectors like technology. You'd also overweight sectors like financials. Healthcare often does relatively well in that environment as well, but you might see the consumer discretionary, or even if you believe that the US government and others will eventually spend fiscally on infrastructure, the industrial sector would probably would be good investments there as well. All of those would show up in our portfolios at the margin. Definitely wouldn't suggest anybody run out and buy one sector as an example. This is definitely a time you want a very diversified portfolio because you can be proven wrong very quickly. Next question was on what would happen if the federal stimulus would stop. Stock markets would absolutely collapse if the stimulus would stop. So right now we're seeing massive stimulus for two reasons. One is, what I say, to grease the financial wheels. One kind of thing I didn't talk about earlier, but with the volatility in the markets and with the massive movements in fixed income in particular, fixed income markets are difficult to trade right now. So the financial services industry is trying to work around that. And in order to do so, they need to provide liquidity to the market. And the Fed stimulus, in fact, actually helps to support the financial services to backstop the markets. All kinds of different programs being put in place where they're buying up different assets, providing liquidity to the market. That's one. The second is providing stimulus from a fiscal standpoint to support loss of income. So whether that's the unemployment provisions that have been made, so there's massive amounts of unemployment, there's extra provisions for people to get paid if they can't find work at all that are outside of those. There's accommodations for companies so they could continue to still pay employees. I was reading something today around airlines actually hiring their people back because they're going to get paid through the government to bring them back online. They may not be working a lot, but they won't be collecting unemployment, just a different way of funding that. That will be critical to try to make sure that companies don't go bankrupt and that they ultimately will have a job for their employees, or at least a great proportion of them, when things settle down and we're allowed to start getting back to work, which ultimately is going to be critical, because all of this, think about the world, it's all linked to consumers and consumer spending. You know, we often talk about the health of the consumer, we talk about the health of industry, we talk about government spending, but at the end of the day, the only reason any of this spending happens is for consumers, for consumption, and we need people to be productive in their jobs, to have a disposable income that they want to spend on new and improved things. That consumption obviously is what fuels the global economy and ultimately fuels growth. So if there was not this stimulus right now, things would freeze up. You would see massive, not just the unemployment numbers we're seeing today, you would see significant unemployment around the world. You would see a collapse really of any global growth. It would be mass devastation if they didn't step in. So it's a good thing they did. They stepped in larger and faster than they ever had in an emergency response, for sure. Next question is, if we have some cash saved now, should we buy stocks or wait a bit more? Yeah, so obviously some cash is a difficult question to answer relative to the rest of your portfolio. As you saw for us, we're sitting with some cash being 6% against a portfolio of 100. So that's, you know, a small amount of cash. We're not buying stocks yet. But as Kelly said, the time when you would want to buy stocks is the time when you would hate to buy more stocks. It's actually probably feels a little bit nicer now because we've seen an uptick in the markets over the last few weeks. Ideally, you want to put that to work when it's at its worst. The challenge that we don't know is the worst past, or do we think it's going to get better? So probably the most prudent approach, if you have cash saved now and you know that it needs to get into a long-term investment portfolio, is to do what investment professionals call dollar cost averaging, which is take your amount of money, chop it up into some amounts, like perhaps 6 equal amounts, and invest a little bit of it now each month over the course of the next 6 months. And at least behavioral, as Kelly was talking, you won't have the regret that you bought in all at once and got the wrong price. You know, sadly, you won't get the glory of finding the best price either. But it will smooth out the ups and downs and make that decision a lot easier for you. If you do have a long time horizon, if you truly have years to invest, it's a great time to invest. The markets are definitely cheaper today than they were back in January. There's good reason to believe that the accommodation that's been happening around the world will work. We will get back to something normal, and therefore the return you will get from stocks today is significantly higher than the return you would have got from stocks just several months ago. Mm-hmm. Is there a better buying opportunity in the next few months? There might be. I certainly wouldn't want to sit on a lot of cash waiting for that opportunity. You'd want to make sure that you are well invested, and if you had some on the margin, find a way to get it into your portfolio gradually over the next little while so that behaviorally you don't feel like you ever got a good or bad price, but long term, it's a good time to buy. Yeah, there's another question everyone's calling for more down is, you know, there's talks of a second coronavirus peak. That definitely is a risk to the markets that I don't think is priced in today. In fact, I would say that the market pricing of the coronavirus risk probably is over. So that sort of peak in the news flow around coronavirus, the peak in the correlation of the markets to new coronavirus information seems to have dispersed a bit now, where I believe that the market's now more looking at the recovery phase and starting to focus on the economy. And in that environment, the Fed's definitely stealing the spotlight by coming out with massive injections of capital on a regular basis, which is definitely supporting risk assets. To some degree, probably no surprise, there's a US election later this year. Very unlikely that a US president would get elected in the midst of a global recession and a market collapse. So they're going to be as accommodative, or Trump's going to certainly be supportive of being as accommodative as possible and deal with the fallout of overspending their budget by a significant amount. He'll deal with that in years to come, and likely he won't be dealing with it anyway. Question around more of the money injected is just borrowed money, and despite that, China might be ready to go on full steam production when we're not ready to consume. Absolutely a risk. there's two questions linked into that. Money is borrowed money, and I said it's borrowed. Think of Back to the Future. It is borrowed from the future in a big way. The amount of the U.S. balance sheet is moved up to $5 trillion. There's been some predictions that might go up to 12 trillion. They're already running deficits before. They likely will be running deficits now in perpetuity. You've got other countries like China that may be back up and running in production mode. The challenge with China and production are two things. One is China does produce a lot of goods, but they do produce a lot of goods for export. The rest are not yet ready to consume, which is a risk to whether or not, even if China's ready to build, no one else is ready to buy. There's other longer term concerns around production. So as much of the production in the last number of years has been moved offshore out of North America in economies like China, there's definitely some friction happening right now around, is it possible to have all the stuff produced overseas, and if those economies become offline in any way, shape, or form, does it put societies like North America at risk? I think you will see through this recession some repatriation of production from foreign markets, which also may have some long-term impact on the economy. Another thought of a question around timing the market recovery, beginning time to the coronavirus peak. Definitely some of the data we're following. If you sort of follow what happened in China, think of every other economy. When it actually started the coronavirus to its peak, China's reaction was obviously much more severe as far as their ability to lock down cities. They were early adopters of that process. A lot of Western civilizations did not do that anywhere near as quickly. So I think that's going to be a bit of a challenge. We are trying to monitor all of those components around the coronavirus. I think the key thing that we're seeing now is, there's lots of talking about the social distancing and people staying at home is flattening the curve, which is a good thing from a coronavirus news flow peak, and the market's perception of that being a risk is likely starting to dissipate. The big issue, as I mentioned earlier, is really around whether or not the economy starts to get back to work and people can be released safely. If we see second round issues coming out of coronavirus and reinfection rates starting up again, that would just suggest we'll need to be self-isolating for an extended period of time. Kelly, you can answer the question, is that babe over your left shoulder?
It is babe. So I'm not the babe. The babe is right there. Yes, that is, this is my women's den. This is my quiet moment in my getting away from my family when I need to. So yes, that is the babe.
Question on real estate. Where do we see real estate going? So definitely a slowdown in real estate for certain at this stage. Longer term, positive for real estate, really off the back of extremely low interest rates. So the fact that interest rates are low, we're now seeing mortgage rates obviously hit all-time lows, which is supportive of real estate. Sadly, because people can't physically leave their homes right now, it's pretty hard to go buy another house and pick up and move. So good chance to expect some pent-up demand after we're allowed to start moving again. Combined with low interest rates, we should see a recovery in real estate if there is a slowdown right now. But no surprise, you should see a slowdown impacting real estate. To the extent that the recession lasts longer and to the extent that the layoffs turn into terminations, that will obviously have a negative impact on real estate as consumers would otherwise been able to purchase real estate would be offline and out of the market. So definitely a good chance we'll see a slowdown. Obviously, regionally in Canada, more pressure out of Alberta due to the collapse of oil prices. It was already under pressure out in Alberta with some challenges in the oil sector with the continued decline in prices. That's only going to put increased pressure on Alberta real estate as well. There's a question on current market situation affecting plans for future MD Platinum offerings. Has not impacted our ability. It's delayed them slightly. So my team is responsible for managing all of the different investments. So as we're bringing new solutions like the MD Platinum solutions to market, my team would be actively involved in developing and managing those. Our attentions have been slightly diverted given the current environment. We typically would meet in our investment committee on a weekly basis. A few weeks ago, we reverted to daily, and daily also includes oftentimes weekends now. So because of just the rapid amount of information that we're trying to consume on a regular basis to be on top of everything, a number of our product offering and build outs are slightly delayed. Our next round, we're looking to launch a platinum private credit solution. So an ability to get into the private credit side of the private market. Elevated returns, obviously in a low interest rate environment, would be a very attractive asset class to add. Still hopeful that we can get something into market into early 2021.
Maybe I'll just make a general answer to a number of the questions that I'm reading there around. A couple of people have asked if it's the right time to get in to buying equities, if it is appropriate to use debt right now, given the low interest rates to buy in. This really is a personal question for you that's asking the question. And the reason I say that is some people don't realize how scary debt can be, even at low interest rates, to invest. Because if you're borrowing 100 grand or 200 grand to invest in the market, and all of a sudden you're still paying interest on that 200,000, and your investments fell, let's say over the 2 or 3 week period from that 100,000 to 70,000, how are you going to react? Do you sleep at night? You know, and these are things I don't know about you when these questions come out, but certainly to work with a person who might be helping you just to get a better understanding of what your true risk profile is. As far as getting into the market now when you have extra money, not so much debt, think about what your long-term strategy is. If you just want to have fun, you know, really the questions that we have around that is think about how much money you have. Think, and I mean overall, not just the amount that you're investing now. Think about maybe play money. You know, if you want to take an aggressive view on, let's say someone asked about cruise lines and car companies and things like that. If you wanted to play with 5% of your assets, what you should think about is, what if you lost those 5% of the assets? What if it became zero tomorrow? Would it affect your retirement? And if you can truly say no, and that you're willing to be able to do that, that's separate from your long-term strategic mix on getting you to attractive retirement.
That's good. Thanks, Kelly. I'll try to get through a few more questions, and I'm just conscious of time. So certainly anybody who does need to sign off, please go ahead and do so. I'll stick around and answer as many questions as I can over the next few minutes. Then we'll wrap it up. And if there are any other outstanding questions that we've missed, we'll do our best to get back to you with answers. A few questions here. There was around TSX versus the S&P. How would you balance an allocation right now? We're definitely ourselves overweight US relative to other markets. It has been much as it has fallen dramatically, it's been very resilient. The Fed has been very accommodative in the US. We do believe that the US market will probably lead coming out of this. In particular, some of the tech securities in the US and the consumer securities in the US have been relatively resilient. Those seem like businesses that will probably continue to prosper. Unlike perhaps the emerging markets, which are at the beginning of this, at least the non-China emerging markets are still at the beginning of some of the challenges and maybe longer to come back online. I wouldn't be like get rid of one market and only use the US, but certainly an overweight to the US is probably reasonable at this stage. There's a question around sectors, and should you invest or try to invest in other sectors that have been hit really hard, like travel industry or airlines, obviously down 80–90%. Definitely an opportunity. We're seeing that throughout our portfolios right now. So I didn't mention before, but we work with about 20 different sub-advisors, so firms that make individual investments on our clients' behalf within our funds and pools. We're definitely seeing a number of them make adjustments to their portfolios. A lot of times in these environments, all stocks are sold off in a similar amount. So you may see two stocks down 50% as an example. One might be an energy company, one might be a travel company, just using that as an example. And in this environment, it might be a view that the energy company is less likely to survive given other challenges, but the travel industry or the airline might survive with the accommodation once we get through this. And therefore, one looks like it has a much more attractive upside than the other on a go-forward basis. So we are making lots of adjustments on that, a number of adjustments on that basis right now, taking advantage of opportunities that have presented themselves.
Craig, there's a question on I'm 3 years away from retirement. Maybe I'll touch on that one. And what should I do now? The reality around being 3 years away from retirement, something that you should remember is that, and you know, this is not something that might be good for you now, but you really should be thinking about retirement and changes in your asset mix if they're appropriate long before 3 years before your retirement. And so that's one of the big things. The other side of being 3 years from retirement is that just because you're going to retire doesn't mean you're going to take all your money out. So let's say that you're 50 years old and you're going to retire at 55, and right now you're asking me that question. You have to think about it as in, are you going to live until you're 90? And so the reality is that you have 40 years for these investments to work for you. How much money do you need to start to take out when you retire in 5 years or 3 years? And so typically, if you're forced to take out money, it might be 5% of your portfolio, which can be covered by cash and fixed income in an event like we're experiencing now. So we have lots of opportunities to be able to work with you. And so whoever you work with, just talk about those types of things and see what kind of money you need in those 3 years when you do retire.
Okay. Great, Kelly. I just went through the rest of the questions. I think in one way, shape, or form, we've captured most of them, if not all. So I think with that, we will say thank you. Good luck investing out there. If there are follow-up questions or other information you need, I'm sure you'll find a way to get in touch with either Kelly or I through your association. We'd be happy to continue the dialogue, to chat with you, any of you individually, or provide other answers to any of your questions. So thank you very much for your time this evening, and please stay safe out there. Thank you.
Thank you, everybody.